Okay. We're going to start talking about a lot of the stuff that you did on the Market Watch journals that you didn't know you were doing, and that is your investment philosophy and strategy. And perhaps it's best I jump in and explain what I mean by an investment philosophy and strategy here. Once you're ready to invest, you have to realize there's not just one right way to invest. Matter of fact, it's very individualized, meaning that there's millions of right ways. It's the one that's right for you that matters. There are multiple ways and multiple methods of investing depending on your budget, your personal goals, and your investment plan. The key to successful investing is knowing yourself and knowing what you are trying to accomplish. Likewise, there's not just one right way to teach investing. And while there are many different ways to teach investing, the principles of wise investing pretty much remain the same. And that's what I'm going to focus on. If you understand the correct principles that relate to successful investing, you'll be able to govern or manage your investment portfolio well. Moreover, while some may dispute the number of principles, no one disputes the importance of these principles. So whatever you decide to invest in whatever phase of investment you find yourself in, the following 10 principles are critical. If you build your portfolio in line with these principles, you're going to have a successful portfolio. So principle number 1, know yourself. Principle number 2, understand risk. Principle number 3, stay diversified. Principle number 4, invest low cost and tax efficiently. Principle number 5, invest for the long run. Principle number 6, use caution if you are investing in individual assets. Principle number 7, monitor portfolio performance against benchmarks. Principle number 8, do not waste too much time and energy trying to beat the market. Principle number 9, invest only with high quality, licensed, reputable people and institutions. And principle 10, develop a good investment plan and follow it closely. Now, I'm not just going to read off these principles to you and hope, okay, there you go, you get it. We're going to spend some time focusing on these principles throughout the rest of this unit for you to kind of grasp what exactly it is you're supposed to do when, for example, invest only with high quality, licensed, reputable people and institutions. Principle number 9, for example. So principle number 1, know yourself as an investor. And investing, as remember, is not an end in itself, something I've already focused on. Rather, it's a means of reaching your personal and family goals. And consequently, you need to know yourself well as an investor. Before you begin to investing, you need to know your goals. You should have well-written, well-thought-out goals of what you want to do with the money. Why are you investing to get this extra money? Goals are critical to knowing yourself because they're going to help you understand what you are trying to accomplish with your investment program. And a part of knowing yourself, you need to know your budget. You can't invest without funds. And a critical part of successful investing is having a well-planned budget. A percentage of your income should be automatically earmarked for saving and investment in this budget. You also need to understand your ability to tolerate risk because this ability will determine what kind of investor you are. You want to develop what's called a sleep well portfolio. Can you go to bed at night knowing there's a risk you might lose all your money, but you still sleep well? Then you're probably can do higher risk. If it's going to keep you up all night worrying about, you probably want a lower level of risk. So a portfolio that's planned so that even when investments go wrong, as they often do, you can still sleep well at night is important. You got to watch for overconfidence in your portfolio. One possible sign of overconfidence is frequent trading. Research has shown that often men are more susceptible to overconfidence than women. A recent study found that men trade 45% more often than women trade, and that men's annual returns were on average 2.7% less than women's annual returns. The study also found that single men trade 60% more often than single women trade, and that single men's annual returns were 1.4% less than single women's annual returns. So you have to be wary of having overconfidence when trading online as well via the computer, because it's very easy to look at it as a video game and to kind of, okay, well, I'll do this, bam, 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 without realizing that it's actually real money. So the same study showed that the same group of investors beat the market by 1.9% before online or internet-based trading. However, when the same group of investors switched to online trading, the group underperformed by 3.6%. So while online trading may appear to give you more control, it can result in lower overall returns if it leads to more frequent overconfident trading. And don't forget all the associated fees and commissions with each trade as well, which will lower your return. Risk and knowing how much risk you are capable of is inherent in all investment activities. And some risks include the inflation risk, business risk, interest rate risk, financial risk, market risk, political and regulatory risk, the exchange rate risk, the call risk, and the liquidity risk. And all these are different risks that will accompany any investment. The inflation risk, will inflation go out of hand and so your return is less than what inflation is? The business risk, is the business run well? The interest rate risk, if the interest rate goes up, people will start diverting money into savings instead of investing in the company, and the company will slow down. The financial risk, will they have the money to continue expanding? The market risk, will people just lose interest in the stock and the stock price will go down, for example? Political and regulatory risk, it's kind of what we're going through in COVID-19. How do you know when the government's going to allow you to open up or shut you down? The exchange rate risk, particularly if it's a foreign investment, and what about the Chinese yuan going down comparative to the dollar? The call risk, that someone will actually call their debt in and the company will have to divert money and slow down growth and even possibly close. And liquidity risk, how quickly can you sell the asset to get the money if you need it? So the key to managing risk is understanding the different types of risks like these and investing at a risk level that is comfortable for you. It's critical for you to find the risk level at which you are most comfortable. Often taking a risk tolerance test will help you discover the level of risk that is right for you. And you can find these online very easily. Just Google risk tolerance test in investing. Diversification, however, is your best defense against risk. You should invest in a variety of assets and asset classes that we'll continue talking about throughout this unit. Diversification does not mean investing in 10 different banks, though. It means investing in different companies, industries, and perhaps even countries. Bank stocks will all tend to go up and down together as an industry. They're highly correlated, in other words. So to truly diversify, you need to invest in different industries and perhaps countries that won't be subject to the same economic factors or risks. Make sure you understand the risks of each of your investments, because investing is risky and uncertain. Minimize risk by diversifying your portfolio. A lot of people review the portfolio returns from various asset classes over the last 10, 20, or 50 years to get an idea of an asset class's performance history and use that kind of as a guide to what they might be able to expect in the future. However, these same people often invest in only one or two single assets instead of investing in a portfolio of 500 or more stocks. They're often disappointed when they do not get the asset class returns they thought they would. So remember, the returns from asset classes are from portfolios of hundreds of assets, not just individual assets. So watch your costs very carefully, including costs for transaction fees, management fees, taxes, commissions, things like that. And remember that regarding investment, $1 saved is worth more than $1 earned, that whole time value of money. And it's because while you have to pay taxes on every new dollar you earn, every dollar you save is already taxed and can then earn interest on that income. Be aware that frequent trading incurs significant transaction and tax costs. So try to keep your costs low. Try to find low commissions or low fees or no fees if at all possible. Defer or eliminate taxes as much as possible. Mutual funds are required by law to distribute 90% of all capital gains, dividends, and interest to their shareholders each year. So while a mutual fund might be beneficial to you if you don't have the time or the expertise or the funds to truly diversify, well, then certainly the drawback is that there might be a tax consequence every year from that as well. So that means you must pay taxes on the distributions from your mutual funds each April, even though you may not have sold or a single share of your mutual fund. For this reason, mutual funds are what we call tax pass-through accounts. This means that the tax consequences of the mutual fund are paid by the investor, not by the mutual fund company. And the impact of the decisions that the portfolio manager of the mutual fund makes on your taxes then can be significant. If they're constantly trading and constantly bringing in money, you might get a big thing, but it's also going to up your tax bill. So invest tax efficiently so you don't have to pay more than you need to in taxes. Remember, it's not the amount of money you make in investing, but the amount of money you get to keep after taxes and inflation that will actually make you wealthy. Invest for the long run. This is how you will achieve your goal. Invest wisely. There's no get rich quick schemes that work. And short term investing is expensive in terms of time, transaction costs, and taxes. You should avoid short term trading. Short term trading is expensive and incurs transaction costs and taxes. And you should keep at least part of your funds in the market for the long run. Keep in mind that taking money out of the market as well as discontinuing saving may not only slow your progress, but could stop it altogether. A recent study found that those who traded more often using the turnover ratio as a proxy for trading had lower returns than those who traded less often and used a buy and hold strategy. In other words, they bought their investments and they held them for 3 to 5 years. If you do have to invest in individual assets, and this is not a given, know what you're investing in. Do your homework. Spend time learning about the company, its financial statements, its management, its short and long-term strategies, its domestic and global industry, and its competition. And I should clarify that what we mean by individual assets is assets that are not pooled, such as a mutual fund. If you want to buy a stock, you should know everything there is to know about the company that you want to buy stock in. So realize that it takes hours and hours of diligent, careful research to investigate a company thoroughly. Don't take others' word for it. Do the research yourself. Of course, finding a great company is not enough. The stock must also be priced right. A great company whose stock is overpriced can still be a lousy investment. If you don't have the time to research individual companies, then seriously consider investing in mutual funds that have many individual assets. And if your mutual fund has 10 stocks, you need to know those 10 stocks well. However, if your mutual fund has 500 or more stocks, you don't need to know those 500 stocks well, because each stock has such a small impact on your total portfolio that if one of them goes belly up, you're still covered. But if you only have 10 and one of them goes belly up, then 10% of your investment is gone. Know who you're investing with. Make sure you invest with mutual fund companies that have built a tradition of meeting the needs of their investors. Work with good companies that have good products, and be very careful with your money and invest it wisely. Now, how can you know how your investments are doing and be wise about them if you do not monitor their performance? And this is where benchmarks come in. Benchmarks are passively managed portfolios of financial assets, meaning that they've been bought and they're held for a long time, sometimes decades. Benchmarks indicate how well your financial assets are performing. If you've ever heard of the Dow Jones Industrial Average, that is a passive benchmark of a group of 100 stocks from the industrial sector whose prices and changes are measured every day to give an average that is the Dow Jones Industrial Average. So when they say the Dow dropped 3 points today, that's what they're talking about. That's a benchmark. And so you can compare your own investment in the industrial sector stocks to the Dow Jones Industrial Average to see how you compare to it. So you should set your own portfolio benchmarks and then monitor your portfolio performance on a monthly, quarterly, and annual basis. Many benchmark returns are available freely via the internet, such as the Dow Jones Industrial Average. If you must invest in actively managed mutual funds, and by active management, we mean they're selling and buying all the time, and they don't hold on to stocks very long, compare the assets performance against the benchmarks you have set, but do it after taxes. If the return on these assets is consistently lower than the benchmarks you have set, consider investing in a no-load mutual fund. A no-load mutual fund is one sold without a sales charge. And low-fee mutual funds with low expense ratios, or index funds, or ETF, electronically traded funds. The return on index funds and ETFs, and an index fund is a fund that matches an index such as the Dow Jones Industrial Average. This fund holds the exact same stocks. Usually the returns on these generally more consistently match the performance of selected benchmarks than actively managed funds. It is very difficult, expensive, and time-consuming to beat the market, to gain returns in excess of the returns on the major asset classes. So the market average might have said people earned, the market was up 1.4% today. And then if you were matching the market, you would have earned 1.4%. The market average over the long term, you might be able to do that day to day, for a few days. But over the long term, matching the market's very difficult. Matter of fact, they did a study where they put ink on a cat's paw and let him walk across the Wall Street Journal, and then they compared what the cat had picked by putting an ink mark on a stock compared to 10 experts and the Cat 1 in the short term. So while it may be possible to beat the market on a short-term basis, it's very difficult to consistently beat the market on a long-term basis. You are competing against hundreds of thousands of professional money managers with much more time, money, and access to databases than you have. If you want to try beating the market, try for a short period of time and compare your returns after taxes to the benchmarks. However, don't waste too much time and energy trying to beat the market, because you'll be able to match the market return with little or no effort through no load, low fee index mutual funds or exchange traded funds. If you feel you have to trade actively, that you want to be a day trader and sit there and play with it, kind of like I had you do with MarketWatch, at least trade efficiently in terms of taxes. Trade in tax deferred or tax eliminated accounts, such as a 401k, Roth IRA, or traditional IRA accounts. And in these accounts, at least your taxes are deferred until you take money out at retirement. And we'll talk about what tax eliminated and tax deferred things are. So when you need help, don't be afraid to ask for it, but get help from good people whose actions and beliefs are consistent with the principles discussed in this section. Good help from qualified, licensed, and experienced financial planners, financial advisors, and brokers may help you in your investment plan. Use the best resources available, but be aware of how those resources are compensated. In addition, make sure advisors have the required licenses to counsel you on the broad range of investment assets you are and should be considering. Work only with licensed and registered advisors, and in some circumstances, fee-only financial planners or advisors may be a better choice than financial planners or advisors that are paid on commission, because they may try to steer you towards something that will get them a higher commission rather than telling you what's in your best interest if you're paid a flat fee. So develop a good investment plan that's consistent with your goals, your budget, and the principles discussed in this section, and follow this plan closely. An investment plan is just a detailed roadmap of your investment risk and return constraints, your investment strategy, and reporting and evaluation methodology. An example investment plan, along with instructions, can easily be found online if you want to see what one looks like. So your investment plan is going to outline the amount of return you're seeking and the risk level you're comfortable with for investments. And this plan documents constraints such as taxes, your liquidity, your time horizon that affects your portfolio. It details which asset classes you will or will not invest in, and includes your view on active versus passive management. Active management is actually going in there and trading, after short term. Passive is just letting it sit for long periods of time. So it lays out your plan for the percentage of gross income you'll invest each month, the amount you'll invest in each of your chosen asset classes, the maximum percentage of your assets that you will invest in any single new investment, and the ways your strategies will change as you get older. Finally, your investment plan discusses how often you will rebalance your portfolio and how often you will report the portfolio performance to others. So think of your investment plan as a roadmap to successful investing. Create a plan that's consistent with the principles discussed here, and you'll do well. If you plan wisely and invest accordingly, you'll save yourself from heartache and problems in the future, and you'll likely achieve your personal and family goals. Now, I've been mentioning asset classes here. Let's talk a little bit about what I mean by asset classes and the various classes here. So before you can build a successful investment portfolio, you have to understand the differences between financial assets or investment assets and investment vehicles. Financial assets are specific classes of securities in which you may invest. So you might invest in some stocks, you might invest in some bonds, some mutual funds, some real estate, money market mutual funds, CDs, and so on. And as we'll learn, these financial assets are grouped into asset classes and are associated with different levels of risk. Investment vehicles, on the other hand, are special types of investments accounts that provide a tax advantage framework that allow you to invest in various financial assets. And tax advantages include the deferral of current taxes. You don't pay them now, you pay them later, such as you'll find in traditional IRAs. IRA stands for Individual Retirement Account, or 401ks, or the elimination of future taxes on earnings. In other words, you pay the taxes now, you don't have to pay them later, as you'll find in Roth accounts or education IRAs. And these accounts are useful because they provide specific tax advantages that are not available when financial assets are purchased individually. So there are lots of types of investment vehicles, and many investment vehicles are geared towards helping you build a retirement account. And most are named after a specific line in the Internal Revenue Service Code. For example, a 401k, line 401, section K. A 401k plan is a retirement plan offered to employees of private companies such as ZF or NAL in Paris. They offer a 401k plan. A 403B plan, section 403, paragraph B, is a retirement plan offered to employees of public companies such as the Marshall School District, public meaning government. A simplified employee plan, SEP IRA, is a retirement plan designed for employees of small businesses to contribute to. And an individual retirement account, IRA, is a retirement plan designed for individuals. And I'm going to show you a table here that shows characteristics of select investment vehicles. But let me again clarify what an investment vehicle is. If I have a 401k, that's a vehicle. Now, I can choose to purchase certain stocks in that vehicle. The vehicle is the account. The stocks are what I have in the account, if that gives you an idea. So here's our table here, and you'll notice that I've got several different investment vehicles listed here, and whether they're tax deferred or tax eliminated, the maximum amount you can put in to meet that tax advantage each year, and what the retirement plan are, what it's for employees of. Now, you'll notice a 401k is tax deferred. Tax deferral is where I put the money in today, but I don't pay the taxes on it until I have to take the money out later. By law, usually that's age 59 and a half. Don't ask me about the half. That must have been a compromise somewhere in Congress. I don't know. Tax eliminated is where I pay taxes on the money today and I don't take it out till later. Now, why would I choose tax deferred or tax eliminated, or how do I choose? Well, if I think I'm going to be in a higher tax bracket after retirement, let's say right now I'm saving up money, but when I retire, I'm going to buy, a large farm that will generate a lot more revenue than I'm making right now. Well, then I would want to choose a tax eliminated account so that I'm paying the taxes when I'm in a lower tax bracket right now. And tax deferred is just the opposite. If I think that I'm going to be making less money at retirement, which is what most people will, then I'm going to want to pay the taxes then when I'm in a lower income tax bracket. So do you guys have any questions about investment vehicles today and what I was talking about? Okay. Well then, everybody have a good day, and hopefully I will see you here tomorrow.